Friends, we will make a beginning with the new topic, underwriting commission. Now, what is this underwriting commission and what is the purpose for which company will pay the underwriting commission? When the company want to go for the public issue, there is always a risk that public may not subscribe. Not that they don't subscribe at all, but what they subscribe may turn out to be too less. And under the provisions of the Companies Act also, what is it? That minimum subscription, there is a concept called as minimum subscription. If you don't get the minimum subscription, then what will happen? Company need to refund the money to the applicants. So, in order to avoid all these sorts of risks, they may go for underwriting of the issue. The underwriting of the issue, there is an agency or a person or a underwriter whom we term them as underwriters. What they will do is they will give a guarantee to the company stating that we will circulate the share applications among the different parts of the different general public, or distribute the same to the general public through different channels, and we will see to that your issue gets properly subscribed. By any chance, in case if that is not getting subscribed, we will take up those shares. Like that, giving a guarantee, we call it as underwriting. Of course, that underwriter who gives that particular assurance to the company is not doing it at free of cost. He will take some commission. That commission we term it as an underwriting commission is the point. So, here try to understand the role of the underwriter. What is the role of the underwriter? He will get into an agreement with the company, and what all that he will do is he will take the share applications from the company and put his mark or seal and circulate the same among the general public. And then next aspect is that in case if the general public are not subscribing completely, then to the extent of the shortfall, that underwriter will agree to take the shares from the company. Of course, once the company is a very big company and public issue is made for crores of rupees, then it may not be possible for one underwriter to underwrite the entire public issue, in which case 2 to 3 underwriters will be there. Now, in this context, when more than one underwriter is there, first, how do you calculate the underwriting commission? Second thing is, when there is an under subscription, how much each of the underwriter need to subscribe to the shares? The second aspect is more dynamic. How do you ascertain the underwriter's liability to subscribe to the shares? In this context, certain terms you should be well versed. Like what? Marked applications and unmarked applications. What do you mean by marked application and what do you mean by unmarked application? That is the application which comes with the rubber stamp of the underwriter, you call it as a marked application. What is an unmarked application? Just because the issue is being underwritten, company will not sit idle. It will also make an effort to circulate the applications among the general public along with the underwriter. So, those applications which go from the company to the general public, they will not go without any marking is the point. Such we call it as an unmarked applications is the point. Then general underwriting and firm underwriting. what is general underwriting and what is a firm underwriting. That is, in case of the general underwriting, what will happen? The underwriter's liability will arise only when general public do not subscribe for it, or what they subscribed is a short of what is required to be subscribed. Then the obligation will come to the underwriter to subscribe. Whereas in case of the firm underwriting, that is firmly certain number of shares will be taken by the underwriter. So with a definiteness, it is not that you have to wait till that particular general public whether they subscribed or not. To the extent the firm underwriting is given by the underwriter, he will subscribe to the shares is the point. Now the practical issues, right? Let us suppose there are about 1,00,000 of the shares. A is giving underwriting to the tune of 60% of the issue. B is giving the undertaking to the tune of 40% of the issue. Now 40,000 shares with the rubber stamp of A received by the company, and 40 more thousand with the rubber stamp of the B, you got the share applications. 10,000 shares applications without any marking came, and the total number of share applications received is 90,000. Then undersubscribed portion is what? 1,00,000 minus 90,000 is 10,000. Now who need to subscribe for these 10,000 is the issue. Then first what you will do, what is the gross liability of each of the underwriter? In 1,00,000 60% means 60,000 and 40% means 40,000. Then you will reduce the market applications. Then you will give a credit in respect of the unmarked applications, because unmarked applications के लिए credit underwriters को क्यों देना? Because unless you reduce the unmarked applications, finally these people liability will not be known. Just because that 10,000 unmarked applications came, can the company say because of your effort and A's effort and B's effort only 80,000 share applications are received, now you please subscribe for the balance 20,000? Not possible, because if these people subscribe for 20,000, what will happen? That 80 plus a 10 which came with unmarked plus this 20 becomes 110. That will not happen. That is, so credit must be given for unmarked applications to the underwriters. Now this credit must be given in which ratio? Is it in the gross liability ratio or is it in the net liability ratio? Liability in the sense like you are after reducing the market applications. Generally all the problems, unless and otherwise the problem is based on net liability, we are doing it on the basis of the distribution is being done on the basis of the gross liability only is the point. Now what will happen, friends? That is, credit for that unmarked applications of 10,000, 6,000 will come to Mr. A, 4,000 will come to Mr. B. But with this distribution, what happened? A's share will be market applications 40,000, unmarked applications of 4,000, totally 44,000, whereas he has given underwriting for how many shares? Only 40,000. So whatever the excess that came to his share will be distributed to the other partner or other underwriter is the point, and in that process we will finally ascertain the individual liability of the underwriter is the point. This does not involve much of an accounting, except that it is a procedure where you should know how to ascertain the liability of the underwriter is the point. Few important theory aspects are there which I will take up for discussion. First, what is an underwriting? Underwriting is an undertaking. What is the undertaking given by the underwriter? In the event of the shares and debentures not being subscribed by the public, shall be taken up by the underwriter. So, the obligation for the underwriter will come when, in the event when general public do not subscribe, or what they subscribe is less than what is being offered, then the underwriter is giving an undertaking before itself that I will subscribe for those shares or the debentures is the point. Then section 76 of the Companies Act says what? Rate of underwriting commission should be the rate what is being authorized by the articles. Of course, first thing is how much of the commission we can pay to the underwriter will get decided based on what? Based on the articles of association. But in any case, it cannot exceed what? As per the section 76 of the Companies Act, what is stated? In case of the debentures, the underwriting commission cannot exceed 2.5% of the issue price. Please remember friends, the underwriting commission is calculated not with reference to the face value, but with reference to the issue price. This is another important thing to be remembered, because when we start doing the problems, then we get the doubt whether underwriting commission is to be calculated on face value or on the issue price. It is on the issue price. And in case of the shares, the percentile is 5% of the issue price could be the underwriting commission. More than that you cannot pay the underwriting commission. Of course, less than that you can pay. So, what is deciding thing is what is being stated in the articles subjected to a maximum limit which is fixed by the Companies Act, that is 2.5% are the in case of the debentures and 5% in case of the shares. So, no commission can be paid in respect of the shares and debentures which have not been offered to the general public. So, the point here is, let us suppose there are 20 lakh shares, 5 lakh shares are being subscribed by the whom? Are being subscribed by the promoters. Promoters have taken up the 5 lakhs shares. So, what is being offered to the general public is what? What is being offered to the general public is 15 lakh shares only. So, the underwriting commission can be paid only on what? On the shares which are offered to the general public, not that those shares which are not offered to the general public, which are being taken by the promoters or which are being issued for what? Acquiring some fixed assets. On that we are not going to pay the underwriting commission. So, point should be very clear in the mind that the underwriting commission is to be paid only on those shares which are being offered to the general public is the point. Then disclosure must be made in the statutory report with respect to what? Each underwriting contract and commission paid or payable. That is, a company need to prepare a statutory report, and in that statutory report the details regarding each underwriting contract and commission paid or payable should be specified is the point. Then the question here is, write about the firm underwriting and also give the journal entries. What do you mean by firm underwriting? Already I explained. General underwriting, there will be two types of underwritings. One is general underwriting and another is the firm underwriting. When we say general underwriting, the obligation arises only when the public do not subscribe for it. Whereas in case of the firm underwriting, it is a specific commitment given by the underwriter that definitely I will take these many number of shares. So, the point is a definite commitment to take up specific number of shares irrespective of the shares subscribed by the public is called as a firm underwriting. And then underwriter is obliged to take up what? Number of shares he applied for in respect of the firm underwriting, and the number of shares he is obliged on the basis of the underwriting agreement. So, once there is a firm underwriting, two types of obligations will fall on him. What are those two types of obligations? One is to take up the shares for which he has given a specific commitment, and second is the number of shares he is obliged to take up on the basis of the underwriting agreement is the point. That is general underwriting. Then what are the general entries to be recorded in the books of the company? First, once the obligation of the underwriter with respect to the shares which he need to subscribe, then the entry that I will write is underwriter account data to equity share capital. To that extent, underwriter account is getting debited. That represents what? Amount to be collected from underwriter towards the shares which he need to subscribe is the point. I am not asking underwriter to immediately make the payment. Bank account data to equity share capital, I am not writing like that. I will first debit the underwriter and credit the equity share capital. Next, we have to calculate the underwriting commission. Underwriting commission is an expense for us. So, underwriting commission account data to, I am not writing immediately bank, because immediately I am not making the payment. So, I will credit the underwriter account. Now, through first entry you debited the underwriter's account, through next entry you created the underwriter's account. That difference we will ask the underwriter to make the payment to us. So, the third entry is bank account data to underwriter's account is the point. Then journal entries, how underwriter will write in his books. This is also another important thing. So, what the entries we have just now discussed is in the books of the company, how the entries are to be written. If you are the accountant for the underwriter, what the entries you need to write? Underwriting account data to a company. Underwriting account data to company in the sense you need to subscribe to the shares of that particular company. So, underwriter account data to company, underwriting account data to company, and company account data to underwriting commission. From the point of view of the underwriter, underwriting commission is a income. That is the reason why we have created the underwriting commission, and it is receivable from whom? From the company. So, debited the company account and created the underwriting commission account. Then with the difference we have to pay the money to the company, that is underwriter has to pay the money to the company. So, company account data to bank. So, there in the first entry you can make the writing like what? Equity share capital in what you call the company account data to company instead of underwriting account, because then if you write like that, one more entry you have to create equity share capital in the company account data to underwriting. Okay, why we should create a fourth entry? Straight away the first entry you can write equity share capital in the company account data to company. So, equity share capital will become an asset for the underwriter is the point. So, that is the investment he has to make, because if the general public do not make the subscription, he has to subscribe. Consequently, what he gets is the equity shares in the company. To that extent he has to pay, he has to receive the underwriting commission. For the difference he has to make the payment to the company is the point. That is what fourth entry. If you at the first entry level, if you simply write underwriting account data to company, how that underwriting account is getting closed, the moment share capital is received, equity share capital account data to underwriting, and finally underwriting commission account data to equity share capital account. So, what exactly this could mean? What is the fifth entry could mean? See, let us suppose I purchased a old building. I destroyed that old building and sold away the wood, old wood and all. Whatever the amount that I am going to get, that income need not be created to the P&L account. It can well go to reduce the investment costs. So, here underwriting commission is an income as far as the underwriter is concerned, and equity share capital in the company is a investment of him. So, this underwriting commission can well go to get closed against that equity share capital account, so that investment amount will come down is the point. Investment amount will come down. Yes, let us suppose Rajani, from Rajani I am purchasing a calculator for 500 rupees. She has given for that particular calculator which I subscribed 2 chocolates of 50 rupees. Now what is the cost of the calculator means what? Original cost of the calculator is 500 less what that I received 2 chocolates of 50 rupees value, that goes to reduce my what you call calculator costs. That's the point. Similarly, agricultural land you purchased for 5 lakhs, when the crop is there, after purchase you cut the crop, then the sale proceeds of the crop will be reduced from the investment cost of the agricultural land, whereby if 5 lakhs is the agricultural land and 1 lakh is the crop that I received, finally my agricultural land cost will be what? 5 lakhs minus 1 lakh is equal to 4 lakhs. Like that only here also underwriting commission is an income for me. Normally I would have closed the same to the P&L account, but here since I made the investment in the company shares, against that investment in the company shares I am reducing the underwriting commission, because this income is arising because of that underwriting, and because of that underwriting I am forced to subscribe for the shares. So the investment cost we are suggesting you to reduce by closing the underwriting commission. Then the procedure for computing the liability of the underwriter where there is no firm underwriting. What is the procedure, friends? See, the whole lot of problem comes with how do you give the, or how do you distribute the unmarked applications among the different underwriters. That is the whole lot of issue. So how do you apportion the unmarked applications? Unmarked applications in the first thing will be apportioned in proportion of the underwriting percentage. So each of the underwriter, what is the percentile of underwriting of him, in that proportion you will apportion the what you call or give the credit for the unmarked applications. What is marked applications? What is unmarked application? Already I explained. Marked application is the one which comes with the rubber stamp of the underwriter. Unmarked application is without any rubber stamp of any underwriter, what the general public subscribed by taking the share applications from the company directly, that and all represents the unmarked application is the point. Then liability as per underwriting. So first what we are doing, first you apportion the unmarked application, first you apportion the obligation as per the agreement, from there you reduce the what you call credit for the unmarked applications which gets distributed in the percentage of the underwriting, then you give a credit to the marked applications. Then if any of the underwriter gets to his credit applications more than the what his obligation, such excess must be distributed among the other underwriters is the point. In which proportion? In the proportion of their gross liability is the point. And the two different approaches is the excess must be distributed in the gross liability is one school of thought, and the second school of thought is that the credit of the surplus of one underwriter must be distributed among the other underwriters on the basis of the net liability proportion. But if the problem is silent, we are distributing only based on the what? Gross liability only. Then procedure 2 here is what? Apportionment of unmarked applications in proportion of a liability after reduction of the marked applications. So first what you will do, that is first what is the liability as per agreement, as per the given proportions you will apportion the shares, and then you will reduce the marked applications, then you will get the net liability. From the in proportion of the net liability you are going to apportion the what? Your unmarked applications, and any excess also should be distributed in proportion of the net liability ratios only. Once we start doing the problem, you can get what exactly this is. The methodology of finding out the liability of the underwriters when there is a firm underwriting. So far what we have covered is when there is no firm underwriting, there is only general underwriting. In case of the firm underwriting, the obligation arises because of two reasons. One is on account of the firm underwriting, on account of the general underwriting. In that case, first what you will do, what is the general liability as per agreement, you will find out. Then you will reduce therefrom the unmarked applications distributed as per agreement. Then you will reduce the marked applications. Then you will reduce the shares applied due to firm underwriting. Then any surplus should be distributed among the other liabilities in proportion of what? In proportion of the general liability due to underwriting agreement is the points. First unmarked, then marked, then the firmly underwritten shares. In that order it is to be distributed, it is to be reduced to finally ascertain what is the individual liability of the individual underwriter to subscribe for the shares. Then the second methodology when there is a firm underwriting is what? You combine the unmarked applications and the firm underwriting applications. First you calculate the gross liability as per agreement, then you reduce unmarked and firmly underwritten applications distributed in agreed proportion. Then you reduce the marked applications, then distribute the surplus of one underwriter among the other underwriters. Then you will get what is the general liability due to underwriting agreement is the points. So this differs from the previous method in what way? In previous method, your shares applied under the firm underwriting will be reduced after marked applications are being reduced, whereas here the unmarked and firm applications are combined and then distributed is the point, and then you reduce the marked applications, then you distribute the surplus. See, in this context, what the underwriters subscribe on account of the firmly underwritten obligation, they will be kept at par with what? At par with the unmarked applications. All of you are able to get my point. In the previous, firmly underwritten shares are given special status, whereas in the second methodology, the firmly underwritten shares are treated at par with the unmarked applications, and just like unmarked applications, how they get distributed between the underwriters, in this both unmarked applications as well as the firmly underwritten applications totally will be clubbed and distributed is the points. That is the end of our theory with respect to the underwriting. Friends, we will take up the problem section in the topic of underwriting commission and underwriting of the issues. The first problem, just have a look at. Ilahi Baksh and Company issued 10,000 equity shares. These were underwritten as follows: A 40%, B 35%, C 25%. 40 plus 35 is 75 plus 25, 100%. In all, applications for 8,000 shares were received. Applications for 2,000 shares have the stamp of A. Those of 1,000 shares are of the B, and those of 2,000 shares are that of the C. There were thus applications for 3,000 shares which did not bear any stamp. If the credit for the unmarked applications is given for ABC in proportion of their gross liability, then find out the obligation of the underwriters to subscribe for the shares. So now in this context, how do we go about? It is a simple problem. First take the basic data. Number of shares offered to the public. Number of shares issued oblique offered to the public. 10,000. number of shares subscribed, number of shares subscribed, 8,000 shares. Then balance, what is the balance? 10,000 minus 8,000 is 2,000. That 2,000 represents what, friends? That is a obligation on the part of the underwriters to subscribe, obligation on the part of the underwriters to subscribe. How much? 10,000 minus 8,000 is 2,000. Then marked applications, marked applications. How do you put the marked applications? A, how much? 2,000. B, 1,000. C, 2,000. Total is how much? 5,000. Unmarked applications, unmarked applications, how much it is? 3,000. So marked applications are 5,000, unmarked applications are 3,000, total applications received are 8,000. So total offered to the general public is how much? 10,000, whereas subscribed by the general public either through marked application or through unmarked application is 8,000. So 2,000 is the number of share to be subscribed by the underwriter. Now the question before us is who need to subscribe and how many number of shares they have to subscribe, because it is not single underwriter, there are 3 underwriters. So right, statement of ascertainment of individual obligation of underwriters, individual obligation of the underwriters to subscribe for undersubscribed shares, to subscribe for undersubscribed shares. First, particulars, then A, then B, one column, C, another column. First, gross liability. First, gross liability. What is gross liability, friends? In the inner column only you write 10,000 in the ratio of 40:35:25. 40:35:25. That and all gives rise to 4,000, 3,500 in case of the B, 2,500 in case of a C is the point. Then friends, less credit for unmarked applications, less credit for unmarked application to be distributed in gross liability ratio or gross obligation ratio, that is 3,000 shares in 40:35:25. So how do you go about? 1,200, do it carefully. 1050, 3000 divided by 10 in 100 into 35, 1050. Next, in case of the C, 750. Reduce it and tell me what is it? Net liability. Or other way around, balance you take 2800, 4000 minus 1200 is 2800, and then 2450, then 1750. Thereby, next, less marked applications. Less marked applications. In case of A, 2000. In case of the B, 1000. In case of C, 2000. So, what is the balance, friends? 800, 1450 minus 250. Minus 250 means surplus. It is the surplus for Mr. C. So, write next. Less credit for the surplus of C. Credit for the surplus of C to be distributed among A and B in 40:35. In 40:35. That means what? 250 divided by 75 into 40, not 40 percentile. 250 divided by 75 into 40 makes it to what? 133. Similarly, 250 divided by 75 into 35, 117. Then balance is what? Actual liability to subscribe. Actual liability to subscribe. Then how much it will be? 667 and 1333. 1333. This is on what approach you have done this? By distributing the unmarked applications in which ratio? Gross liability ratio. There is another approach called as net liability approach. Right. Ascertainment of, one more statement, ascertainment of underwriters to subscribe for the shares. Brackets, net liability basis, brackets, net liability basis. What is it, friends? First, gross liability as per agreement. Gross liability as per agreement, that is in the particulars column, A column, B column, C column, all you open and say that gross liability as per agreement 4,000, 3,500, 2,500. Less marked applications, less marked application, less marked applications. How much is the marked application? 2,000, 1,000, 2,000. Then net liability, net liability. What is net liability? 2,000, 2,500, 500. Now, less credit for unmarked application, less credit for unmarked applications to be given in the ratio of net liability, to be given in the ratio of net liability that is 20:25:5. What is that net liability? 2000, 2500, 500. So 20:25:5. So how the net liability you are arriving at, friends? Net liability is arrived by reducing from the gross liability the marked applications. What you get is the net liability is the point. So in that proportion you apportion. So that 3000 if you distribute in 20:25:5, what will happen? 1200, 1500, 300 credit will come. Thereby final liability how much? 2000 minus 1200 is 800, 2500 minus 1500 1000, 500 minus 300 200. Then that is how you are going to distribute the unmarked applications. So try to make the distinction between these two. In the first case, first you are giving the credit for unmarked application by distributing the unmarked applications in the gross liability ratio, then you reduce the marked applications, then the excess is being distributed. In the second situation, first you will reduce the marked applications, then you will find out the net liability. In that net liability ratio, you apportion the what you call unmarked applications. Even if some surplus is coming, that surplus also goes for distribution in the net liability ratio. This way the things need to be moved. Let us look at the second question. Newton Limited incorporated on 1st January 1999 issued prospectus inviting the applications for 20,000 equity shares of ₹10 each. The whole issue was underwritten by Adams, Benjamin and Clinton. We will call them also as ABC because two big names, Adams, Benjamin and Clinton. Okay, that is fully underwritten by them. So उनका gross liability ratio क्या है? Ratio क्या है बोले तो 5:3:2. How come? 10,000, 6,000, 4,000 means 5:3:2. Applications were received for 16,000 shares, of which marked applications are as under: Adams 8,000, Benjamin 2,850, Clinton 4,150. You are required to find out the liabilities of the individual underwriters. Write down basic data. What is the basic data? First, total number of shares offered / issued to the general public. Total number of shares offered / issued to the general public. What is it, friends? 20,000 less total number of share applications received. Total number of share applications received 16,000. So balance is what? 4,000. That again is that balance you write number of shares to be subscribed by the underwriters. How much it is? 4,000. Next, total applications received. 16,000 less marked applications. The inner column, Adam 8,000, Benjamin 2,850, Clinton 4,150, put together is how much? 15,000. Put it to the outer column, so that the balance is what? Unmarked applications. So in this problem we only ascertained the unmarked applications. So unmarked applications. So on the statement at top there should be a heading. What is that heading? Statement of ascertainment of unmarked applications. On this particular workings top, every working should have a heading. That is statement of ascertainment of unmarked applications. Statement of ascertainment of unmarked applications. So what is the unmarked applications that you found? 1000. Now we will ascertain the individual liability of the underwriters. How do we do that? Right. Statement of ascertainment of individual underwriters obligation. Individual underwriters obligation. How do you do that? First, gross liability as per agreement. Gross liability as per agreement. Of course, particulars, A column, B column, C column, Adam, Benjamin, Clinton columns. First, as per agreement, how much it is? 10,000, 6,000, 4,000. Next, less credit for unmarked applications. Less credit for unmarked application distributed in gross liability ratio. Distributed in a gross liability ratio. How much it is, friends? 1000 in the ratio of 5:3:2. 5:3:2. That is 500, 300, 200. In which case it comes to how much? 9,500, 5,700, 3,800. Less credit for marked applications. Less credit for marked applications. That is A 8,000, that is Adams 8,000, Benjamin 2,850, Clinton 4,150. So that what will happen, friends? That is Adams further obligation is 219. How much is the Adams further liability? Not 219, 1,500. And that of the Benjamin is how much? 2,850. That of the Clinton is 350 surplus. The 350 surplus of the Clinton must be distributed in which ratio? 5:3, right? Surplus of Clinton, surplus of Clinton to be distributed in the ratio of 10:6. So 350 divided by 16 into 10, kitna? 219 must be given to the Adams, and 350 divided by 16 into 6, 131 is to be given to whom? To the Benjamin, so that the balance to be that against minus 350 you make it plus 350. Now you tell me how much is the net liability or final obligation of Mr. Adam and Benjamin. Final obligation of Adam and Benjamin. How much? 12812719. So slowly we are getting into the underwriting commission concept with the proper understanding of gross liability, net liability and all, but except in the first problem which we are doing, wherein it is stated that you learn both the methodologies, but generally the questions are given with what? Asking the students to do it in the gross liability ratio only, either distributing the unmarked applications or distributing the surplus is being carried out in the gross liability ratio. Now I move to the third question. Rosie Limited made a public issue of 4 lakh equity shares of 10 each. Rupees 2 payable on application. The entire issue was underwritten by 5 underwriters, A 25%, B 25%, C 25%, D 10%, E 15%. Under the underwriting terms, a commission of 2% was payable on the amount underwritten. Further, the underwriter was at a liberty to apply during the tenure of the public issue for any number of shares, in which case he was entitled to a brokerage of 0.5% of the par value of the shares so applied. That is, along with the general public, even the underwriters also can subscribe, and if they do it, we will give them additional brokerage to the tune of what? 0.5% on the value of shares so applied. Applications received were to be analyzed on the basis of the rubber stamp of the underwriter, who was to be given credit for the number of applications received bearing his rubber stamp. Applications received which did not bear the rubber stamp were considered as a direct applications to be credited to the underwriters in the ratio of their respective underwriting commitments. If any such credits being given, a surplus was to result in respect of any underwriter as compared to his commitment. Such surplus was to be distributed amongst the remaining underwriters in the ratio of their respective underwriting commitments. As a result of the issue, the following applications were received bearing rubber stamp of A 1,02,000, B 95,000, C 60,000, D 32,000, E 51,000, not bearing any stamp 10,000, put together is 3,50,000. Included in the number of applications mentioned against D in the above table was application made by the D himself for 10,000 shares. The underwriters were informed of the amounts due to, or from them the amounts were duly received or paid. Show with the aid of necessary workings the entries to record the amount so received and paid is the points. Now first basic data. Write down the basic data. Total number of shares offered oblique issued to the whom? General public, 4 lakhs. Then next, number of shares received, number of share applications received, 3 lakhs, 3,50,000, correct, 3,50,000. So balance is what? 50,000. What is that 50,000, friends? That is a number of shares to be subscribed by the underwriters. Number of shares to be subscribed by the underwriters, how much? 50,000. Total applications received 3,50,000 less unmarked applications. Unmarked means without bearing anybody's stamp is how much? 10,000. So that balance of 3,40,000 is what? Marked applications. The marked application. Statement of ascertainment of individual underwriter to subscribe for undersubscribed shares, to subscribe for undersubscribed shares. Particulars and then A, B, C, D, E. Individual columns for the A, B, C, D, E. First, gross liability. Gross liability as per underwriting agreement. Kitna? 4 lakhs into 25%. 1 lakh, 1 lakh, 1 lakh, 40,000, 60,000. How come 60,000? 4 lakhs into 15 by 100, like that you please tell. 4 lakhs into 15% is equal to 60,000. This is what? Gross liability. Less credit for unmarked applications. Less credit for unmarked applications to be distributed in the ratio of 25:10:15. What is it, friends? 2,500, 2,500, 2,500, 1,000, 1,500. Then friends, less credit for marked applications. Straight. Less credit for marked application. If time permits, at each stage we will balance. If time don't permits, we will not carry that detail. It all depends on the time which is available in the exam. Do it fast. Less credit for marked applications. 1,02,000, 95,000, 60,000, 32,000, 51,000. Now you please tell me what is the surplus or the deficit. In case of Mr. A, what I am finding here is there is a surplus to the tune of 4,500. How come? 1 lakh is the gross liability, 1,02,000 marked applications, 2,500 unmarked applications, so 4,500. As far as B is concerned, deficit is 1,500, 2,000, kaisa? 1 lakh minus 2,500 minus, so it makes it to how much? Correct. C. C is how much? 37,500. D is how much? 7,000. E is how much? 7,500.